We're good to go, Mr. Cole.
Good afternoon, everybody. I hope everyone is well. Welcome to today's Finance and Appropriations Committee. Today we have a fairly robust schedule, agenda schedule, and I want to first go and get started with quorum.
Board Member Brown,
Here.
Board Member Cole,
Here.
Mr. Green,
Here.
Ms. Johnson,
Here.
Mr. Jordan, Mr. Miller,
Here.
and Board Member Ragland.
Here.
And you have a quorum?
Awesome, awesome. In addition to that, I want to make sure that I get my screen up for this. It's always fun doing this on the go. This virtual thing never gets tired. But if we could, is there a motion to accept the agenda?
So moved. Second.
All right, we have a motion and a second.
This is the motion to approve the agenda. Is that correct?
Yes, sir.
Okay. Board Member Cole,
Yes.
Mr. Green,
Yes.
Ms. Johnson,
Yes.
Mr. Miller,
Yes.
Mr. Ragland,
Yes.
and Mr. Brown.
Yes.
That motion carried.
Thank you, sir. Now moving forward, is there a motion to accept our minutes?
I'll move it.
Second.
Mr. Green,
Yes.
Ms. Johnson,
Yes.
Mr. Miller,
Yes.
Board Member Ragland,
Yes.
Board Member Brown,
Yes.
and Board Member Cole.
Yes, sir. My mic went out.
Thank you. And that motion carried. Thank you.
All right. If we can go on to our first agenda item, please.
Thank you. The first agenda item is the monthly financial report. And of course, I have to figure out how to start my share screen here. Bear with me. It worked fine when we started this.
No, I don't think any of us are mad at you. It just seems to be one of those technology days.
Yeah, I minimized the screen somehow. Okay, so here we go. We should be all set. Good. Monthly financial report for September. Thank you. All right, year to date through September, revenues are up ever so slightly, 2.4 million on 358 million in total, about 0.7%. Expenditures are still running down year to date, 13.3 million under plan, about 5.7% on approximately 217 million in year to date expenditures. Those variances combine to leave our ending cash balance about 15 million above plan through the month of September. Highlights on the revenue side, property taxes. The settlement was received in the month of September, a month later than usual because of the delay in the final payment deadline. And state aid running just slightly above plan at 1.3 million. The property tax allocation, the rollback, and part of that is also homestead exemption, is 14.3 million under plan, but that's a timing issue it has come in the month of October. And then in the other revenue category, about 6.5 million above plan. The bulk of that is about 4.6 million above plan in our pilots, and those are payments in lieu of taxes. I do want to pause for a moment and talk to you about the plan. Later in the next presentation, you will be hearing about the November. You'll be hearing about the November 5-year forecast, and it's my intention to use the November 5-year forecast instead of the May forecast as the basis for our month-to-month plan. So I will plug in the November forecast, and then in the month of October, you'll see comparisons to that plan. And that way, as we meet on a monthly basis and talk about these variances, we'll be comparing to the most recent forecast that we have, and it'll just give us that current base to compare to. So there will be some changes. For instance, in the November plan, the property tax estimate has been increased over the May forecast. So this favorable variance of 9.4 million might go down a little bit because we increased the overall annual estimate for that category. Similar variances will occur in other categories as well when we do implement the November 5-year forecast. But those are the highlights on the revenue side. Graphically here, you can see the property taxes are running above plan a bit, state aid pretty much on target, and all other revenues slightly under. And the all other revenues, you'll see here that it's all due to the property tax allocation and timing. Other revenues, the second column from the right are the pilots, as I mentioned, and other financing sources is really a carry forward from the previous months, and that has to do with the timing of advances in that were posted. This month, I'm introducing, instead of my typical discussion about variances, and I think I wrote to all of you about this, I'm borrowing this, I guess you could say, or lifting this from the work that we had done in the past month on our risk assessment. And the organization we worked on that with uses this heat map concept to categorize variances well, really not variances, but to categorize risk and do it in terms of heat as highly likely versus highly unlikely. I modified that to look at our variances and code them from very unfavorable to very favorable with gradations in between. And I set up not only the dollar amount variance for each category, but also the percent variance for each category. Admittedly, this is my dichotomy. This is what I kind of had resonating in my mind and how I set this up. And you can see that revenues and expenditures are exactly opposite from one another in terms of favorable and unfavorable. So beginning at the top, variances that are a negative variance of 10 million or more would be very unfavorable for revenues and very favorable for expenditures, in that if you're under plan on revenues, that's not good. And if you're but very favorable if you're under plan in terms of expenditures. So that's the basic outline of how this heat map will work. And I think when we look at revenues, you can see how it just draws your attention right to the most significant variances, both on a monthly basis and year-to-date basis. So looking at the year-to-date columns, you can see that the property tax allocation just jumps out at you as a dollar amount as being very unfavorable. And we know that that's timing. All the other dollar amount variances are either on plan or pretty much favorable, a little unfavorable in state aid. As I said, that was very close to being on plan, but it's just one category off. This also demonstrates that sometimes large percentage variances don't equate to large dollar variances, and you would see that in line 206, other financing sources. But I think this is a pretty good pictorial way of displaying for the reader what our variances are for the end of September. On the expenditure side, personnel continues to run under plan. We're now about 15.8 million under plan. Purchase services, about 7 billion under plan. And in that, that's in professional technical services and property services. Charter, STEM, and scholarships pretty much on plan, just slightly 996,000 above. Supplies and materials have had kind of a wild roller coaster this first quarter. If you look at the chart in the MD&A for this month, you'll see that our experience in July, August, and September of this year is vastly month to month different than what it's been in the past and what history would tell us. But all in all, at the end of the quarter, we ended up on plan. So those month to month variances, in essence, worked themselves out. Capital outlay, about 6.9 million above plan. And that is attributable to the 7.15 million in computers that we purchased with the City of Columbus money. That was not in the May forecast, which is the basis for our spending plan. And other objects are pretty much on plan. Graphically here, you can see personnel is the one that stands out as dollar-wise being most under plan. Again, purchase services, under plan. Capital outlay kind of sticks out here, those computer purchases. We'll look at the heat map. And again, you can see capital outlay unfavorable in terms of dollar amount, very unfavorable in terms of percent, but your eye is attracted to there. And the rest are, many of them are on plan or favorable. So I think this is a pretty good graphical display of where we are. So again, revenues slightly above plan overall, expenditures running under plan for the month, and our cash balance is a little higher. So that's the end of my report for the September monthly financial report. You're welcome.
Thank you, Mr. Treasurer.
Ask some questions.
Are there any questions?
Just a quick question. Yeah, what was the MU again?
Moderately unfavorable.
Moderately unfavorable. Okay, got it.
I think that's what we called it. Let me go back and yeah, it's moderately unfavorable. So from yeah, moderately unfavorable.
Got it. Thank you.
Mr. Green, did you have a question or no? Okay. Mr. Ragland?
I did not.
Okay. All right, thank you. Moving on to the 5-year forecast.
Stan, I do like the heat map though, but I like the change.
Thank you. I've become a fan of the heat map myself. It actually is one of the first things I look at when I go to write up my analysis, because it just automatically draws my attention to it. All right, so this is the forecast, the 5-year forecast for November. In this forecast, the actual years, we roll back. 2017 goes off the forecast, and 2020 becomes an actual. So 2018 to 2020 are the 3 actual years. Fiscal years 21 through 25 are the forecast. And as you all know, I like to carry out another 3 fiscal years and project that simply based on trends. So those 3 years, 26 through 28, are included in this presentation for discussion purposes. We will, I note here the dates of October 14th, this presentation, and then November 4th to the board presentation, and then November 17th adoption. During the board preview of next meeting in October, I suggested that perhaps I present this next week to the board with adoption on the 4th based upon some other presentations that are coming down the road for the board. So we will be presenting this, or I will be presenting this next week to the board and then adopting it on November 4th. So I'll update this slide to reflect that change. One other change on this title slide is that you may or may not have been aware, and you might not notice that over on the left-hand side, I include folks that have assisted in the preparation of this. Heretofore, it was the treasurer's office, and then the budget office, which was Mr. Gooding, because Mr. Gooding's budget office reported to the superintendent, and then also policy and government affairs. A couple of changes effective, gosh, I want to say last Wednesday, as a result of a recommendation of the PDK audit and the desire of the superintendent to have the grants management team be more closely aligned to the academic side. We split up Mr. Gooding's office, and Mr. Gooding now reports to me along with his budget analysts, and the grants management folks will now be reporting to Catherine Mosier on the academic side. Dr. Roush, we changed his departmental title. He was board liaison there for quite some time, and so we dropped that because now he is focused entirely on policy and government affairs. So a little update there on staffing and organization. I always begin with the discussion of forecasts, and I'll go quickly here because you've all seen these numerous times. My favorite quote about forecasting, that it is very difficult, especially if it's about the future. We do have a legal requirement to file this here in November, and then once again by May 31 of next year. And anytime significant events occur that dramatically change the forecast. The Ohio Department of Education has a great document on how to read a forecast. These are just some of the quotes that I've pulled from there. And what I like to say is this is a snapshot. It's the best information we have at this time, and that it's only really as good as what I know today. And especially now, tomorrow, things could be dramatically different. There are many events out there that could occur. We'll be discussing some of those at the end of the presentation that will potentially have an impact on this projection. Lots of variables out there. Some we have some control over, some we have little to no control over. And that uncertainty contributes to the fact that what actually happens, what we actually experience, will absolutely be different than what I've projected herein. And in kind of in closing this little introduction, again, it's just a snapshot about what we know today and a whole lot of assumptions about the future, and it's all subject to change. So on to the November forecast. Since May, the main thing that has happened is the fiscal year 20 came to an end. So I have the actual results to work with, and those actual results will feed into future years, and I'll discuss that line by line. So the adjustments for future years, again, reflecting our actual experience for FY20, and then also the 21 to 25 budget process that Mr. Gooding has led the district administration through, and we've plugged those numbers in as well. I'll go through several of the more significant lines in the forecast and show you how they've changed. We begin with general property taxes, line 1.01. You'll see here that there has been an increase in most years. Over that 4-year period of the May forecast, 20 to 24, we had almost $21 million in estimated revenues, just about a 0.8% increase. This has to do with reflecting our actual expenses, and then also looking at the next line, which is 105, the property tax allocation. When we look at property taxes in the aggregate, a portion of that is paid directly by all the taxpayers, but then a portion of that, the rollback, is actually deducted from not paid by the taxpayer. It lowers the taxpayer's bill, and the state of Ohio pays that to us. But it all comes out of the same property tax calculation, if you will. And based upon actual experience, whether it ends up in the first line or the second line, that can change a little bit, as well as the timing from settlement period to settlement period. So you can see, while I might have increased the property tax line, based upon this most recent experience, I've reduced the property tax allocation line. But when I bring them all together, you'll see that in the aggregate, a smaller percentage increase, but relative to property taxes, during the life of the forecast, about 12.9 million in income has been added, or about 2.6 million on average each year. Just a minor adjustment. I'll note too, in the far right-hand column, the fiscal year that rolled into the picture now, which is 2025, no comparisons could be made back to the May forecast since it was not part of the May forecast, but I thought I'd at least add that in for your reference. On the state aid side, the biggest thing here is that in the May forecast, we didn't know about the $9.2 million reduction that we would experience. That reduction in fiscal year 20 carried forward to fiscal 21. So we started fiscal year 21 at the reduced level, and that's being reflected here in dropping that revenue estimate throughout the life of the forecast. In addition, in FY21, when I was putting this together in response, I guess, or in reaction to the pandemic and closure of the casinos, I simply dropped the casino revenue for fiscal year 21. It's $2.5 million. It was just as easy to drop it out rather than try and guess, we're going to get half of that or 40% of that. I just took it out. So you'll see there in the totals that the total for 21 is 347.2 million, but it jumps up 2.5 million to 349.7 in 22 and thereafter. So that's just the casino revenue I pulled out in 21. All other revenues, two items here. Number one, I went ahead and increased the investment income line about $2 million for each of the years based upon our experiences. And you can see in fiscal year 21, 7.15 million of the money from the city of Columbus came into us. That was where the city of Columbus shared some of their CARES Act money with us, and we bought computers with that money. In total, this is how all of those lines and several others that I didn't discuss, but all of those lines on the revenue side combined during the life of the forecast, just a minor adjustment, pulling 6.5 million in revenue out, down about 0.1%. Our breakdown, pretty typical, stays pretty constant. Two largest sources of revenue: property taxes, 54%, another 4% in property tax allocation. So everything that those dollars related to property taxes amount for about 58%. State foundation program, our second leading revenue source at 36%. I always like to talk in the forecast about variances and the magnitude of those variances. So I share with you that a 1% variance in each one of these categories and the dollar amount that it might mean, so that we could be 1% off and have an almost $10 million swing in revenue one way or the other. Just to keep that in mind, so that when you see actual results come in, you might say, wow, that's a $10 million swing, but it can amount to just 1% of our overall revenue. So just to put that in context for you as we look later on here at some scenarios of possible outcomes. Here are the most recent year that we finished, 2020, and then the 5 years of the forecast with the categories stacked on top of each other, so you see their relative contribution. And here, as a percent to total, I've added, again, the property tax and property tax allocation together to get 58%, about 37% from state. That stays fairly constant throughout the forecast, but at the end, we're at a 61-35 split, mainly because state revenues remain flat during this forecast, yet property taxes do climb a bit year to year. Moving on to personnel, you can see here that in FY20, what we put in the May forecast came down a bit because the May forecast did not account for the 11.8 million of expenditures that we are recoding to the Student Wellness and Success Fund. So we made that adjustment throughout the forecast. In fiscal year 21, though, it and beyond it jumped another 5 million to about 16.8 million that we're going to recode. And in fiscal year 21, we added in about 4.7 million in personnel costs in anticipation of the Digital Academy, and that's a one-time cost. So you can see that while there was a reduction for what we recode to the Student Wellness Fund, there was an increase relative to the Digital Academy. Overall, pulling out about $61 million during the forecast in terms of these expenditures. Purchase services. I think I noted earlier that on the non-personnel side, we set them in the forecast at their budgeted amount. We did not reduce them for the historical underspend that we experienced. So they're in at their budgeted amount. So you can see that from 20 to 21, that jump is from an actual number to a budgeted number. So it's going to seem kind of significant, but that budget, using the budget amounts, is in line with our conservative forecasting practice. And I will say that certainly, having just gone through some rating agency presentations, that the rating agencies certainly look favorably on, shall we say, beating your budget or coming in under budget as opposed to the other way around. So by using the budget number and knowing with a pretty high degree of confidence that we will likely spend less than that, this does make the forecast conservative in terms of its impact on ending cash balance. So that's what the adjustment here is putting those budgeted amounts in, and what we now have budgeted versus what was available to us in the May forecast. That added about almost 64 million in that for that period through 24. Supplies and materials, same issue with adding the budget in. You can see we add about almost 16 million in expenditures through 24. Capital outlay, not quite as drastic, but in 21, you can see the 7.6 million increase in our estimated expenditures, and that is directly due to the 7.15 million in computers, the City of Columbus CARES Act money. So you can see that it was reflected now in both the revenue and the expenditure side. Total expenditures then, with the decrease in personnel and the increase in non-personnel, they somewhat balance each other out, pulling about 5.5 million out each year of that period 20 through 24, that 5-year period. In total, about 27 million increase in expenditures through 24. I will note an interesting thing. In 2021, we will cross the $1 billion mark in terms of general fund expenditures. Here's a look at how the expenditures lay out over the life of the forecast. You can see that jump from 20 to 21 because of the budget amounts being used. Also notice that the two largest categories are personnel and purchase services, but as we like to call out, within purchase services, a significant piece of that is charter. So you can see here that charter consumes most of our purchase services account, and it becomes the second largest expenditure category. On a percent to total basis, same thing. About 89% of our budget, or of our actual expenditures in 89% of our expenditures were for personnel and charter. And during the life of the forecast, it's between 85 and 87% forecasted. Talking about variances in our expenditure line items, again, you can see the categories here and how they break out. But more importantly, here's the 1% variance in each one of those categories. Clearly, personnel variances can contribute the most to affecting the ending cash balance. Charter, we're probably pretty close on that, so that won't likely move. You can see here that only 14% of our budget is in non-personnel, where we probably have the most control. But given the amount that we have in purchase services for things like utilities, other charges for things like tuition, we don't have much control over, so that there isn't a whole lot of discretion in the budget per se, and that's what I'm trying to demonstrate here. And the last two categories, debt and non-operating, those are much smaller portions, but those are pretty much fixed for our budgeting purposes. Again, very, very close to a $10 million swing for a 1% variance. And this will, I want you to keep that in mind, along with the just under 10 million in revenue for 1% as we get into the analysis of some possible scenarios. Bringing it all together, an ending cash balance. You can see here that at the end of the May forecast, we had projected a $46 million positive balance. With these adjustments, that has dropped to 12 million. And 25 that rolled into the picture at this time, we knew it would be negative. That would have been one of my trended years in May. We knew it would be negative because, as you can see here, in terms of the, see if I can turn my laser pointer on. When you look at the ending cash balance, it's dropping each one of these years. So we are spending more than we are bringing in. So that trend would carry forward into the negative category for 25 at a projected 106 million. Graphically, it looks like this. Some of our key points are here. Expenditures begin to exceed revenues in 21. That's when the cash balance begins to decline and we're deficit spending, if you will. The yellow line is our 30 days cash balance. We crossed that, or we're very close to it in fiscal year 23, and we drop below it in 24. And our first negative projected year is fiscal 25. Another way to look at the 30 days cash balance is to introduce a reserved cash balance, which is simply the ending cash balance less the 30 days of expenditures. And so you can see again, it shows that here in 24, when reserved goes negative, that means we're not hitting the 30-day cash balance target. And when both of these are negative, not only do we not hit the 30-day cash balance, but we are negative in cash overall. Downward sloping curve, as I've said before, that's not a sustainable picture, but there are many variables that will change this picture over time, which is what I want to get into now and run for you several scenarios just to give you an idea of the magnitude of where the balance might end up. This is my hurricane map discussion. So I start first with a pretty favorable picture that, let's say we achieve a 2% more in revenues and 2% less in expenditures, both working to our favor in terms of cash balance. And you can see here that at the end of 25, should that occur, we'd move from 106 million deficit to about 92 million positive, which actually, interestingly enough, is we would hit our 30-day cash target. Another scenario I wanted to look at is thinking that I could be pretty spot on revenues. Generally speaking, I might be better at that than I am expenditures. So if I'm spot on with revenues, no variance there, but we consider the fact that we don't spend our entire budgeted amounts and perhaps we come in 5% under that, what might that look like? And so you can see at the end of 25 that the cash balance goes, the projected cash balance goes from a negative 106 million to a positive 143 million. I also have to give not a doomsday projection, but something the opposite of that more favorable one. And I chose to do minus 1% in revenues. In other words, we come in short on revenues by 1%, and we exceed our expenditure plan by 1%. You see here that the 106 million then is driven to 205 million negative. So the point of this is to just to give you an idea that these 1 or 2% variances either way, depending upon how they come together, that over course of time we could see that 2025 ending cash balance come somewhere between 143 million positive to 205 million negative. And this is why when I show something like 106 million in a deficit in that fifth year, I'm not on the phone to the superintendent saying, you need to change your behavior. You need to get into a expenditure reduction mode, because I know that maybe organically this will work itself out. And absent a discussion about addressing a deficit through expenditure reductions, we need to talk about, again, about the other side, and that is addressing it through an increase in revenue. And what does this forecast tell us about the timing of an operating levy? And I want you to remember, this is, the forecast. A lot of things can happen. I don't think that the 106 million deficit is cast in stone by any means, but using that as a starting point, let's talk about levy timing. I've done this before. This should look very familiar. Calendar years run across the top. Fiscal years are shaded because July, December of one fiscal year combined with January through June of the next fiscal year constitutes the next calendar year constitute a fiscal year. Here, I've just numbered the calendar years 1 through 8, and then I've numbered the fiscal years correspondingly, fiscal years 2 through 8. The nomenclatures that are fiscal years are called by the calendar year in which they end. So the fiscal year, which in this case would be technically fiscal year 1, 2, it ends in fiscal year 2, so we call that fiscal year 2. What I've done here is to have a theoretical vote on a levy in the fall of calendar year 1, in that July to December time period. And I have picked a theoretical 6 mills. We generate about $11 million per mill, and I split that 33 million in the first half, 33 million in the second half. The red line is where we should focus. That's the accumulated dollars generated by a new levy over time. And the purpose of this chart is it allows you to look at your cash balance data, pick a year in which you want to address that deficit, and you can come back here, look up your deficit, and figure out how many years do I have to go back and put a 6 mil levy on the ballot in order to have enough time to collect dollars to address that deficit, like this. So let's take this is our cash balance forecast. And if we go out to the final year of the forecast, FY25, and look here at the deficit, and I'm going to pick this one, 198 million, because I think we should plan to 30 days cash. So we need to go back to the chart and find where on the chart we'd be if we needed to generate about $200 million. In this case, with some rounding, it would be right here. So if that's how many fiscal years do I go back to determine when I have to be on the levy? And it's just simply 1, 2, 3 fiscal years. And you have to be in the fall of that fiscal year to put an issue on the ballot. So I go, see if I do this right. If we can get back to, I got to go back 1, 2, 3 fiscal years. So here we are in 25. I come back 1, 2, 3, it's fiscal year 22. That the fall of 22's fiscal year is actually the fall of 21. So you would need to be on the ballot in the fall of 21 to address this $200 million deficit. Updating the chart with the actual fiscal years, you can see here, fiscal year 25, $231 million to help offset that deficit. We would need to do 6 mills in the fall of 21. Not saying that's what we should do, because we're not sure that's how the forecast is going to end up. But the point of this discussion is that the sooner you respond to that deficit, the easier it is to address it. If you wait too long, the only way you address that deficit is that the millage has to go up, or you have to switch over and address it by expenditures. None of that should be news to any of you, but I thought I'd walk through that one more time in light of this new forecast. Our early warning indicators, once again, our expenditures begin to exceed revenues in fiscal 21. The ending cash balance drops below our 30-day target in fiscal 24, and we have our first projected negative ending cash balance in FY 25. What are some of the things that can impact our cash balance? What are some of the things that can happen to this forecast that cause the cash balance to be greater or less than what's in the projection? We've brainstormed a few of these. Quite frankly, I left one off. I can't believe I did it. But certainly increases or decreases in state aid can have an impact. Budget talks in the next biennium begin in the spring of calendar year 2021. And we'll see how that goes. One can only hope that we would get at least our 9.2 million back and then plus some, but we don't know. There's a new state aid funding formula on the table. There's another name for it, but we call it the Cup-Patterson funding model. Dr. Roush is on this meeting, and he might here in a minute jump in and give me the better name for it. But that's one thing that I put on the positive side, hoping that if we do have a new funding formula, that it would mean more money, not less money for us. On the decreased cash balance side, I have imbalanced change in student wellness and success funding. Right now, 16.8 million in student wellness and success funding is coded into a separate fund. And we take 16.8 million of our general fund personnel expenditures and recode them to that fund, dollar for dollar. So that's balanced. In this forecast, I assume that the student wellness and success funds will continue to exist, and that they will continue to exist in essence, in a balanced fashion at that $16.8 million level. Should there be a change in that funding that's not balanced, for instance, if the funding to the Student Wellness and Success Fund were to be reduced, but there would be no increase in our basic aid on the general fund side, and I would have to bring some of those Student Wellness and Success Fund expenditures back to the general fund, that would be an increase in our expenditures and a decrease to our cash balance. I have chosen to leave Student Wellness and Success Funds cash balance neutral throughout the forecast. Some of my counterparts are not doing that. You may hear some other school districts say, well, I've brought back my Student Wellness and Success Fund expenditures, but not the revenue. As you can imagine, that would deteriorate the cash balance picture fairly dramatically. I don't know that there's any solid reason to do one versus the other. I think that this picture is still conservative, and it's just my call that I don't want to bring them back unnecessarily. It's just hard for me to envision that they would cut that funding without a commensurate increase in other state aid. Non-personnel expenditures could come in less than budget. We know that's a fairly high likelihood, but that would serve to increase our cash balance. We might have additional COVID-related expenditures. We don't know where this is going in the next few months or a year. We have a pretty good amount of CARES Act funding, several different grants, and we're using those dollars first to address our COVID-related expenditures as we prepare to open school. But should we have have to spend more on COVID-related that the CARES Act money doesn't cover, then that could impact our general fund cash balance. One of the things in the personnel area that we can have some control over our substitute and overtime costs. That could work in both directions. You're going to hear later this afternoon a proposal about teacher substitute pay. And it's not for a reduction, it's for an increase. So that being factored into the forecast would drive our cash balance projection down. And overtime costs, we will likely have some increased overtime for cleaning and sanitation of our buildings as staff and students return. So to the extent that we can control that, that will have an impact on our cash balance as well. We're working on, the board is working on a new strategic plan, and certainly I anticipate that there's going to be some programmatic things come out from that. And it could increase our expenses, it could decrease our expenses. We could be expense neutral. Don't know whether we'll be adding or whether we'll be reallocating, from other areas, but that's just another variable. And lastly, the one thing that I left off, I can't believe I did this, is labor negotiations. In our personnel projections, we include the costs of the currently negotiated collective bargaining agreements. It's a 3% increase through fiscal 22. In this plan, as I have done in other plans, I add in 1% for the ensuing years. Knowing that there will likely be some increase, I guess. 1% is a placeholder, but to the extent that it's more, obviously that reduces our cash balance. If it's less, then it serves to benefit the cash balance. So you may have some other items of your own that you have in your mind that I could add to the list, but those are some of the variables out there that are on the horizon that can impact our cash balance and either minimally or dramatically change this picture, this forecast picture. That's it for the November 5-year forecast. I'd be glad to answer any questions at this time.
Thank you, Mr. Treasurer. Are there any questions at this point? Awesome. Is Dr. Roush is on? If you can just speak briefly again to the House bill that the Cupp-Patterson piece, if you could just speak quickly to that.
Certainly. So it's the Cupp-Patterson, or the Ohio Fair School Funding Plan is its official name. It is currently sitting in House Finance Committee. It's anticipated that we will see a sub-bill yet for that by the end of this General Assembly. I'm not sure it's going to pass this GA, but it certainly sets the foundation for going forward into the next budget cycle. Essentially, this direct funds students, so we don't have any more of these deductions for Ed Choice, no more deductions for charter school students. It really creates an inputs-based model. So it really kind of looks at what it takes to educate a student, kind of the typical student, within a bunch of add-ons for students who have exceptional needs, whether that's special education, English as a second language, gifted and talented, etc. So it kind of builds all those out, and then it still maintains that state-local share that exists. The sub-bill is anticipated to make some modifications to that, but that state-local share is a combination of income and property wealth. So that's kind of it in a nutshell. We could go a lot longer and go component by component, but I have a feeling that that's Stan saying no, so we won't do that.
I'm saying no as well. But I just wanted to make sure that folks at least had a better understanding of what that variable is. And more importantly, again, thank you, Mr. Treasurer, for pointing out how this variable can possibly impact us in any number of scenarios. But provided there, yes, Mr. Ragland.
Thank you, Mr. Chairman. Thank you, Mr. Behort. My question is to Dr. Roush. As we look at the House legislation, are there things that you would suggest to this committee and to the Board of Education that we can be doing to speak with the public to increase their knowledge about what is happening at the State House and how it impacts their children? Being that we know that things are happening there, I know that legislators respond positively or negatively to public influence. And as these conversations are ongoing, is there a suggestion that would allow the board to educate the public about what is happening and the impact that it's going to have? And then maybe some idea around how we can use the parents and guardians and supporters of the 50,000 students that we have here in Columbus to kind of push the legislature to make something happen on behalf of our children.
Thank you for the question. I think that certainly once we get the substitute bill out with hearings, I think being able to give you a nice rundown, trying to keep it more than to just about 2 pages, that's sometimes difficult for me. I tend to be rather verbose, but giving you just kind of a quick and dirty rundown of exactly what that bill will do and what those components are. And I think what's nice about the funding formula is that the components are easily understandable. Folks know what's going into it. If I asked most folks on this call right now, what are the components that go into the current funding formula, or I should say the funding formula that existed a while ago, most folks would really struggle to identify what those are. And if I further asked, can you justify how they came up with the cost components for those, how they costed those out? Most of us, including myself, would say, I can't give you a rational basis for what those were, because I don't know that there was a rational basis when those were put into law. This does that. I think that the other piece, vis-a-vis engaging parents, I think that as we work with, I'd like to work with the board certainly on that to identify the best way of engaging our legislators, our elected officials. I think that there's certainly some capacity there to be able to further educate those officials who are not on the education committee. We're fortunate we do have a few that are on education and on finance, but I think further educating some of the other members that we have within our district and really kind of being proactive and saying, look, this plan, this model is a good starting point. I think everybody knows it's not going to get funded fully on day one, but it addresses a lot of the issues that we've been having with the model for the last 10 years. It guarantees and caps are not going to go away overnight. There will be a phase in for all of this, but I think one of the biggest things is that we're funding students where they actually are. We're moving away from this model of deducts and you know, for lack of a better term, the some of the fuzziness that then occurs with some of the accounting mechanisms that happen. There's some, I mean, there are charges that are levied, whether accurate or inaccurate, that certainly come with our local dollars leaving. Is it a further deduction of the state dollars that a district should be receiving? I think that what you often get, especially when you come to the community school and the ed choice piece of this, is it creates a situation of conflict where there doesn't need to be a situation of conflict. If the state wishes to pay for those particular programs, they can certainly do so. I think that they should be upfront and honest about what those programs cost. And oftentimes those costs are hidden within the mechanism that exists currently.
Thank you for that, Dr. Roush. And thank you for allowing me to ask the question, Mr. Chairman. I do believe that the supporters that we have for this district are really a sleeping giant when it comes to advocacy at the State House. And I just want to make certain that we keep that at the forefront of our thinking as we've heard from our treasurer today, what our long-term challenges are starting to look like, educating the public on how the state influences the decisions that we're making around our table, Mr. Chairman, is going to be critically important to our success. So I really appreciate engaging in that area, Dr. Roush. Thank you, Mr. Chairman.
All right, I agree with you and thank you as well. Okay, Mr. Treasurer, moving on to the risk assessment.
Thank you. My office just in the past 2 months embarked on a risk assessment with the help of Clark Schaefer Consulting. A risk assessment of our department has been recommended and asked about by our internal audit staff time and time again. in part because it's a good idea and in part because I got tired of them asking me about it, we went ahead and started off on that path to not only conduct the risk assessment, but to learn about how to do it and what's all involved in doing a risk assessment. I did share on the agenda the report from the firm, and I would like to walk through now some of the highlights of that report with you this afternoon. As I said, this was a venture engaging Clark Schaefer Consulting. They delivered this report to us on September 8th. The scope of this work covered these areas within my office operations: source and use of public funds, cash management, accounting, financial reporting, payroll, IT systems, receivables and payables, grants, process improvement, and fixed assets. The risks that we talked about were also identified in various categories, these 6 here, and we rated them in those categories. Anywhere, financial, compliance, operational, reputational, kind of what I call headline risk, fraud, and technology. In assessing the risk, we looked at 2 things: likelihood, that is, what do we believe to be the likelihood that this risk would actually come true? And then impact. If it did, what would be the impact on the district, the financial impact on the district? And then you can see by this chart that that low and high combination can give you 4 different combinations of risk. Obviously, the green or the lowest is low impact and low likelihood, all the way up to high impact and high likelihood. And let me say that this risk assessment was a self-risk assessment. These were risks that not only Clark Schaefer brought to us, but ones that we identified ourselves. And then, as you'll see, we looked at both inherent risk, that is risk before any controls were in place, and then the residual risk, that is likelihood with our risks involved, with our controls involved. Impact didn't change. The impact is the impact, but the likelihood changes with the institution of certain controls on our operations. You can see here how we organize them, and this is the beginning of the heat map that I lifted from this and now use for my financial report. Frequency of risk all the way from weekly to not very often, 20 plus years that it might happen, and then impact from detrimental to slight. And you scored all your various risks in this way. And then at the end of the time, when you get your inherent risk, you can take that inherent risk score and evaluate the effectiveness of controls. They're either ineffective, partially effective, or effective, depending upon the score. The heat map is generated thusly. You can see that you score them both impact and likelihood from 1 to 7. And there's that combination. You add the 2 scores together. So the lowest possible score is a 2, very low in likelihood and very low in impact. And so you end up down in the bottom left-hand corner at a overall very low risk, all the way up to a maximum of 14. And that would be over in the upper right-hand corner, a very high risk category. And so again, heat map works you from low risk to high risk in the gradations of color. Another part of this report summarizes our scores by functional area. There were 146 separate risks that we evaluated spread through these functional areas. This is the accumulation of those scores, the averages of those scores. And so you can go into each one of these functional areas, look at the individual risks. And while, for example, treasury activities might score over here under residual risk as medium low, you still could have some treasury activities that were in a higher category, but on average for that functional area, it worked out to be a medium low risk, moderately low risk. So you can see how this worked. We start here at inherent, without any controls. How did we evaluate our inherent risk? What did we think the impacts were? And then with our controls, our self-assessment of how well our controls work brought our residual risk down to here. And you can see they're mostly moderately low to low. And then the evaluation of our control effectiveness. I will point out that the accounts receivable function area is, for all intents and purposes, just getting up to operating. The district really doesn't have a lot of accounts receivable, but that functional area is beginning to fire itself up for a variety of reasons. And so our evaluation of that in terms of being ineffective is because we really don't have all that control mechanism yet set up. Also in the report, back in the appendix, they take our highest inherent risks and list them for us. The inherent risks, those that exist without any controls in place, so you have a pretty good idea of what you really have to keep your eye on. Also in the report in Appendix B is a list of all our risks, all 146. And as you can see, for instance, here, this particular risk, a likelihood of 7, an impact of 4, an inherent risk of 11. But we think with our controls, the likelihood is or the likelihood with a control is a 7. So the impact of 4 with a likelihood of 7 is 11. In essence, our controls, it still is a high risk in this area that in our estimation, the controls aren't in place to take care of that particular risk. And you can scroll through this whole report and see each one of the risks that we self-assessed. As important as anything in the report, at the end, we are provided with a risk management plan, and they introduce the concept of an enterprise risk management effort. We've done this for our department, and I believe this firm, as well as our internal auditors, I can let them speak for themselves, but I believe they would recommend that there be an enterprise risk management effort in place throughout the district. But this management plan talks about all sorts of things. How to conduct the plan, how to identify risk, how to evaluate risk, how to do what was done here. It's all spelled out here. How you keep this plan up to date, how you keep this assessment up to date. And so it wraps it all up as a primer on how to move forward. So the next steps for us are one, the assessment of our controls, a self-assessment of our controls. We need to go back and document those it's as simple as writing down those controls. What went through our minds when we said, well, I think our controls are sufficient to lower that likelihood from a 5 to a, we have to go back and document what are those controls, write that down. So, because right now it was just a self-assessment. After that, the next step would be testing those controls. We said that these controls would do this. Are they in fact doing that? And then we'd have to have someone come in and do some testing of that. All of that is much longer than the month and a half to 2 months that we spent on this, but those are the kind of the next steps that this leads us to. And I included our Office of Internal Audit in on these discussions and at our closing conference. I hope this is right up their alley and what they were looking for. But this is our risk assessment. It's a fairly lengthy document, 40 some pages, I think. You can take a look at it. But I just wanted to give it to you and let you be able to take a look at it and ask questions or discuss it if you like. But just one more thing that has been recommended to us that we move forward on, And you're never done with things like this. It's the beginning of an ongoing process. And so I'll answer questions, or I know I worked with. I'm looking at the list. Harold Saunders is here. I worked included him in on the conversations, and Carolyn is here as well. So if they have anything to offer, I'm open to that as well.
Thank you, Mr. Treasurer. Madam Internal Auditor.
Thank you, Chair Cole. And it's a very worthwhile exercise, one that our office has been encouraging, not just the Treasurer's office, but because in the title, it's Enterprise Risk Management. So it really is looking across the entire enterprise and identifying where those risks are, what's the possibility that if we don't mitigate those risks, we will not be able to achieve our objectives, and then coming up with a plan to make sure that that does not happen. So this is definitely a step in the right direction. As Stan pointed out, it is a self-assessment. We would like to look a little, look at the document itself to see what we can rely on when we go to do our annual assessment for our purposes. And I'm quite sure with the work that they have done, it will cut back on some of the work that we will have to do. So it's very encouraging. And as Stan said, Harold Saunders from my department has been working, not really with them, but providing consulting services, and we will continue to serve in that manner.
And we wanted to make sure that Carolyn's team understood the framework that this firm took, and they wanted to understand the risk framework that Carolyn's team might have. So what I didn't want to have to do is do a crosswalk between two different risk assessments, because I didn't know much about risk assessment coming into this. So what I didn't want to have is to have apples over here and oranges over here. I wanted something that we could use collectively. And I think this document, especially the last part on the risk management plan, can be somewhat of a template. It's available for other departments to take a look at, and really, I would have felt a lot more comfortable going into this had I had something like this to read, and get a good feel. Now that we've been through it, it's just, we can, nobody should be afraid or worrisome about doing a risk assessment. I don't know how to put that, but it was like, geez, I didn't know anything. And after this, you kind of have a feel that, all right, now we've got this template we can work from, and we can go back and my staff was familiar with the process and how to go through it. So all in all, as Carolyn said, step in the right direction.
All right. Are there any additional questions or comments? Okay. Thank you so much, Madam Auditor, for chiming in on this conversation and, again, leading this effort organizationally from a risk management standpoint with a lot of the work that you've accomplished over the years, let alone this year. So thank you. Mr. Treasurer, we can continue on to our sub plan.
Okay, thank you. This evening, I think this might be his debut here with the Finance and Appropriations Committee. Mike DeFabo from HR, and he's here to talk with you this evening about a very important proposal. It has to do with our substitute teacher compensation plan, and I will let him take it from here and walk you through his document.
Stan, thank you so much. Thank you, board members and committee members. I really do appreciate your time today. And yes, this is my first time with the Finance and Accountability Committee. And I just appreciate your time. So thank you in advance. What I'd like to do is walk you through a proposal for our sub-teacher compensation plan. I want to explain the details and rationale, and of course, answer as many questions as I can. At the end of the walkthrough, I'm hoping and requesting that you will formally recommend to the board that we take this for consideration. I think that everyone who has been engaged with CCS for a while knows that we do have a substitute issue that we need to address. And this is one piece of us starting to look at how we will address that. So I'm going to share my screen here. Okay, can you see my screen? Excellent. Okay, so our vision here is very ambitious. It sounds simple, but it's not. We want to be an employer of choice for all of our employees, and we want that applied across the spectrum. So we're really looking at how do we become an employer of choice for substitute teachers. We know we're not the only school districts, and we know that our substitute teachers have choice in where they want to work. So this is addressing the first piece of that, which is really substitute compensation. Our rationale, and I'm going to get into some of the nitty gritty here with you. Our sub-teacher pool is at a historic low. 2 years ago, we were at 525, last year 450, this year 380, and that is horrible. I don't know if any of you are familiar with my background, but I come from DC public schools. We had more than 1,000 substitute teachers every year I was there. It's the exact same size school system as our school system here at CCS. And we also have the very same average daily sub rate, which is usually between 400 and 450. Many of our buildings are obviously having trouble finding and keeping subs. So we do have some culture work to do outside of this compensation plan, but I want to try to show you as much of the big picture as I can here. Our starting pay is among the lowest in the region, and I'm going to show you at the end of this presentation all the comps from districts around us. It paints a pretty clear picture actually of where we are in relation to how we pay our substitute teachers. This point is really critical to understand. It costs more per day for the district to have a teacher covering, or multiple teachers covering the absence of another teacher than it does to cover with a substitute teacher. And this is actually in our contract with CEA. We pay 6 times the supplemental rate, which right now equates to around $207 a day. So we pay our largest pool of substitute teachers is our group of day subs. They make $95 a day. So we're paying an extraordinary amount and taxing our own teachers to cover when someone is out of the building. The last piece here is that we know overcrowding is an issue, and when we can't find a sub, and we don't have a sub, and we do have a teacher who needs to cover that space, it makes our classrooms larger. And that's why we pay our teachers more when that happens. But we know that class size is a big issue, and we don't want any type of negative impact on student learning or any type of operational efficiency. So our strategy, again, this is our strategy in terms of compensation. We have many strategies going into how we fix our sub problem here. And those include recruitment and a whole bunch of other things. But the one I'm going to talk to you about today is increasing sub compensation to make us more attractive. We need to be a more attractive employer. We need our compensation to be the best in the region. We're the largest school district in Central Ohio. We should be paying the best that we can and the most attractive offer where possible. Substitutes with a general sub license. And this is our main subgroup. This is someone has a bachelor's degree and they are not a teacher, but they just have a sub license through ODE. So the first piece is we don't want to pay them $95 a day anymore. We want to bump them up to $126. And I'll show you why, the why of that. But right off the bat, we want them to become part of our community and we want it to be attractive in terms of recruitment. what usually happens is after 40 days, we pay a differential. So they start to be paid more if they're working continuously. And so I'll walk you through that on the next slide. But for substitutes with a teaching license, and these are our unicorns, and our retired teachers are in a separate category, but these are anyone who's a substitute. They're an actual teacher. They have an actual teaching license. Many times they're in a pipeline to become a full teacher with us. And we would increase their daily rate from 125 to 140. So if we look at some dollars, which is what I like to do, I want to make sure we're spending our money correctly and efficiently. For the last 3 years, you'll see how our sub-teacher fill rate has gone down and down and down. You'll also see that our sub-teacher spend has accordingly gone down. Our classroom reassignment has lowered as well. So the overall, we're seeing a decrease in class coverage spend. The problem being that we have not changed our need. So we're just seeing classes not be covered in the ways that we need them to be covered. And so this is a huge issue that we need to address. We want that sub-teacher fill rate. Even at 70%, that's not acceptable. We need that way higher. Again, I come from a district where it was over 90 and I kept it over 90. I want us to get there here. So we need to do this incrementally. We know we need to do it incrementally, but I'd like to see us, just jump back up over 70 and then set some really clear targets and clear goals and aspirational goals about how we can raise that even further. So here's our current sub-pay structure, and there's two pieces of this that I think are really important. The first two groups, actually the first three groups are the groups that we're really paying attention to the most, because this is the bulk of our substitutes here. The first is our non-standard. This is our bachelor's with only a sub-license. Again, we pay them $95 a day, and after 40 days of consecutive work, they go up to 110. So that's our big group here. The next biggest group is our bachelor's, and they have a teaching license. Again, many of these folks are in pipelines to become full-time teachers, and we pay them $125. So we also have retired teachers who we love. They're the backbone of any substitute program in any district. They know the kids, they know the community, and they just go out of their way to do everything they can, but they're also retired. So they're going to work when they can, and they're going to do everything they can to support us. But we can't fully rely on that pool just because we know they're retired already. After 60 days for all of those groups, they are benefits eligible. So they start to see some prorated sick leave and personal leave. And we have this last little group, which is an instructional support substitute. These are actually in our bargaining agreement with CEA. They are paid as a teacher, and we can only have 30 of them across the district. These are what many people consider building subs. So if you hear someone say building sub, this is usually what they're talking about. They're a CEA member working as a substitute teacher. And we have some buildings who purchased these positions with grant dollars this year. You'll hear me say probably over and over again in my tenure with CCS that the absolute best use of a substitute is when they are ingratiated into a school community. They are most effective. They are most readily available to cover classroom when someone is out, and they can jump between, mostly because they know the teachers, they know the students, and they can really address the needs of the building on any given day of the week. So here's what we're looking at in terms of our proposal. I talked to you about those first couple groups, which are, to me, really the backbone of our sub program. We want to take that initial non-standard substitute and raise them to 126 a day. And what we're looking to do is any of those subs who are working for more than 60 days, hopefully consecutively, because again, one thing that we're also doing is part of this work is we're assigning substitutes to buildings directly, very much like that building sub that we were talking about earlier. So we're hoping that they will come in and work consecutive days. And if they do that, we're looking at increasing their pay as an incentive to doing that and offering their benefits. That other group, of course, is the standard with a teaching license. This time we would include our retired teachers here, and we would take them to 140, and more than 60 days, they would go to 250. And on the 61st day, just like the other group, they would be benefits eligible, all of that based on consecutive work. So our incentive is, there was a time when a day sub made a lot of sense in education. I'd like us to move away from that if we can. I really want subs that are invested in our communities. We're recruiting from our communities. They're attached to school buildings, and they want to come and work with us every single day, especially if they're interested in a pipeline to another position within our district. So here is where the good stuff is. This is how we look right now as it relates to other school systems around us. We are matched for the lowest daily sub rate. And again, this is for that first group of subs that really makes up the largest percentage of our sub pool. We start to get a little bit more competitive after consecutive 30 days. And then after 60 days, we start to get a little more competitive as well, but you'll see we're still way low as it relates to some of our competitors. Obviously, retired teachers, we do a great job. We want to make sure that we continue to compensate them to the best of our ability. They are rock stars in our world. So this is what I have for you today. I would love to entertain questions. I know this is a lot of information, but I'm hoping that you will see that we're moving in the right direction here. We want to do what's best for students. We want to make sure that they have continuity of education when someone is out sick. And it's really top of mind for everything that we're doing now in HR.
Thank you, Mr. DeFabo, for the presentation. Are there any questions at this point?
Thank you. That was very helpful. I do have a question. So you mentioned that having a teacher cover the classes in an event you can't get a sub is very expensive. So would increasing the pay here even, is it going to be a wash in the end, or what is the impact to the district financially is really what I'm getting at here.
Yeah, absolutely. Thank you for the question. So if I hop back to a previous slide, this slide here, if we kept these fill rates for these years and we just increased based on this proposal, we're looking a little bit under $2 million as an increase. So that is just to increase the pay. That is not increasing our fill rate. And I talked about DC as a comp before. My sub budget there was $10 million, and we paid $120 a day, and that was it. There was no differentiation at all. It was $120, and that's what you got. Just to give you some type of idea for how we maxed out there, really. And again, that was at a 90% fill rate. But yes, to your initial question, I would expect classroom reassignment pay to go down, and of course use that to supplement substitute teacher costs.
Great.
Thank you for that question, Ms. Johnson. Are there any additional questions or insights? Any feedback?
Yeah, I've got a question. And I think I understand all this, and you know, it makes a lot of sense to me. But I want to ask a little bit broader question. concerning substitutes. I am aware, and I hadn't really realized that ESC also has a subpool. And I learned it in part because that's where Gehanna is going for substitutes right now. And learning that made me wonder, has there been conversation at any point, or should there be, about a pooling of substitute teachers in Central Ohio or in Franklin County at least? Where it's all of the school districts are competing with one another over the rates, and that's a tough thing to do, and consequently, in some ways, all school districts are losing as a result of that competition. And if we could cooperate and pool and set a common rate for substitutes, we might all benefit. And there may be some that need to be attached to buildings for particular reasons, or but it might be worth exploring. Just a thought.
I think that's a really great thought. I've spent a lot of time exploring what it looks like to outsource substitute programs in large urban school districts. I've seen some horror stories there, and I've seen the opposite. And so I tread into that space carefully. But I think what you're suggesting is actually sort of a level 2 approach there. And I really appreciate it. So I definitely will look into that. Thank you.
Yeah, I at least my initial reaction is simply outsourcing it. We lose a great deal of control, and we're dependent on somebody out there. But school districts, among others, have had great success with cooperative arrangements in purchasing with other districts. And, that's become more formalized than it used to be, because I remember putting some of these together for the very first time back in the 80s when I was with another school district. But, applying those concepts today, take a look.
I will. Thank you, sir.
Thank you for that feedback, Board Member Brown. I will say, Mr. DeFabo, that I agree with you with that being a kind of secondary stage thought. Maybe that's a plan B, because having been somebody who had been in that world for a short time, it's important that we make ourselves competitive in the marketplace. Bottom line. And what I like about this plan is that it at least does that, and does that at a living wage above $16 an hour. So I appreciate the fact that it breaks out to be 18 bucks an hour for work. I appreciate the fact that it is a scalable piece that goes to a certain amount incentive wise if you work consecutively, if you stayed faithfully with the district. I love to see where there's growing opportunity, and that's more above us. That's more like the state. But I love to see where we can actually continue to work with substitute teachers to grow them and accommodate their growth into the space of actually being real teachers with us. That is not an easy thing to do in the state of Ohio. It just isn't. As much as there's a need for instructors in the classroom, teachers period in districts all across the state, the state does not make it very easy to acquire a teacher's license. But all that aside, I like what I see with this plan. Is there any recommendation necessary for us to move this forward to the board for for consideration?
Yeah, Mr. Cole, I think that it would be appropriate if the committee was so inclined to simply adopt a resolution that you recommend that the board consider this proposal.
Awesome.
I mean, just that they, so they know that you've seen it, that in part you like the idea, but you're not saying that they should adopt it, but just that they should consider it and take a hard look at it.
Mhm. Yep. Always a recommendation on our behalf for consideration.
Yeah.
But with that, is there a motion to
Can
do
I,
so?
I see Mr. Ragland's hand, and I actually am going to violate a staff rule and ask my own staff member a question. So if you would like Mr. Ragland to go first, that's fine, but I do have a follow-up question.
I would, Mr. Ragland.
Thank you, Mr. Chairman, and thank you, Mr. Behoric and Mike, for your presentation. I would like to see more work, to your point, Mr. Chairman, on how we can sweeten the pot a little bit on the incentive side, and a comprehensive plan in how we could work with the state and our educational partners around that certification program. I think it's complementary to this, but I think it's important enough that it should go with this, because I think that the two are inextricably linked right now. I mean, if we are, I'm envisioning a plan, and Dr. Dixon has articulated this before. We need to be very focused in making sure that we get more people of color to be teachers in our district. And if there's a way that we could prop up some of our HBCUs that are here within the state of Ohio, the two that are here in the state of Ohio, and provide opportunities for certification programs across the board, meaning you don't have to be an African American to be a part of this type of a program. But if you are, that's even better for me. But if there's an opportunity there, that might be a mode that we could pursue in a comprehensive plan in pushing this forward. And so I'm glad that you brought that up, Mr. Chairman, because it is very difficult. But that does not mean that we cannot begin the process of articulating what our needs are. And Mike's really put a real good emphasis on what our needs are here today. But then start talking about what needs to happen in order to make that process a lot smoother, so that we can address our own needs. And I would bet that we'd be able to find some willing partners at Central State and Wilberforce that might be able to help us, as well as some other local partners here in town. So with that, I will make a motion that we move this presentation forward to the Board of Education for its review.
I second.
Mr. Brown, you're muted.
There we go. Sorry. Yeah, I think that Stan said he had a question.
Yeah, we've got a motion on the floor, so that's fine. We can just one other I guess maybe point. I think what is probably most interesting to me is not so much the dollar amount of the pay rate, while that's important. I think what's very interesting to me is the extension of the availability of health benefits. And because I think that I know for a large portion of our staff members, they truly work for the medical benefits. And I was just wondering, Mike, it says, that you're eligible for benefits. Just a brief conversation or comment. I'm going to assume that that's like regular employees at their regular contribution rate. And then that they qualify, and that's for a certain period of time. That there's I have a son in the he's an actor, and in order to qualify for benefits with Actors Equity, you have to be on stage so many months in so many weeks in the prior year, and that qualifies you for the next 52. I mean, it's a little bit convoluted, but because they work this odd job kind of a thing. And I'm wondering, is that something that you envision where you qualify for benefits for a certain period of time? because I think that's the hook. I don't know how else where to put it. So I just, hopefully that's a hanging curveball for you to answer, Mike, but I think that's an important aspect of this whole proposal.
Yeah, Stan, thank you so much for that. I agree 100%. It's one of the reasons why we introduced this like we did. The benefits are employee only. They kick in after the specified period of time, and then we carry those out through a specified period of time for as long as the person continues to work, and then prorated moving forward. So yes, absolutely. And again, we want to become employer of choice here at Columbus City Schools. And we're going to start to see a lot more community-based recruiting. You're going to see a lot more pipeline work, a lot more teacher prep work as it relates to programs that we're working with and growing programs. I know that you're the finance committee, and I'm trying very hard to stay within that framework, but I always get really excited when we start to talk about teacher pipelines. So yes, absolutely. I appreciate what you all have brought up today. Thank you.
Again, thank you, Michael.
So you have a motion on the board, Mr. Chairman, on the table.
Yes, so is there a second?
You did. Mr. Ragland made the motion and Ms. Johnson seconded it. You're all set.
Short memory lapse, I apologize. All right, so we can cast vote here.
Ms. Johnson,
Yes.
Mr. Miller,
Yes.
Board Member Ragland,
Yes.
Board Member Brown,
Yes.
Board Member Cole,
Yes.
and Mr. Green.
Yes.
And that motion carried.
All right. Thank you so very much. I look forward to the opportunity to see this come before the Board of Education more formally. And again, in preparation for that, if these other elements that were discussed along benefits, along some other things can be included, I think that would be awesome. I'd love to learn more about it. All right. Thank you, sir. With that, is there a motion to adjourn?
I'll make the motion.
Second.
All right. Motion and seconded.
Mr. Miller,
Yes.
Board Member Ragland,
Yes.
Board Member Brown,
Yes.
Board Member Cole,
Yes.
Mr. Green,
Yes.
and Ms. Johnson.
Yes.
That motion carried. Thank you all.
Thank
Thank
you
you.
all. As always, thank you so much for your time and your service. I look forward to the opportunity of seeing each and every one of you ideally in person at some point in time. But until that time comes, I wish you all great wellness. I wish you all to be safe and just take care of yourselves and your families. All right.